Good day everyone, see you again. Today our discussion talking about how to avoid bad stock from fundamental analysis point of view using a stock valuation calculator. So there is some tips we would like to point out and stressing. First is we need to avoid bad stock because such a stock have very low return on equity. So the question is why? You see in this picture, actually return on equity consists of three type of assessment, three type of analysis. First is to assess the company and industry profitability. To assess the profitability, of course, we are looking at the bottom line, net income after tax, and divided by sales they are making, the turnover or the top line. So we are getting the return on sales. Next, the assessment is on the operation of the business. The operation of the business consists of certain assets that utilize, that produce a top line, that produce a turnover or sales. So this is the ratio of asset turnover. So next assessment is about financial flexibility or the financial capability of the company. If we are looking the financial leverage, we are looking at the asset of the company divided to its equity. So combine three assessments, we can produce return on equity. So basically return on equity comprise everything what's most important in the business, in the company. So the bigger the its ratio, the better return on equity. Especially we are talking for the expansion. For the expansion we are talking the financial leverage. Asset compared to equity. The lower of the equity, there is a chance to obtain cheap fund through IPO, right issue, or obtain a fund from third party like issue bond, corporate bonds, obtain the bank loan. So asset grow is showing good bottom line, meaning there is good profitability, that profit coming in, and then it will inflate the asset, whether current asset or non-current asset. So in the contrary, on the right side of the balance sheet, there is a liability and equity. So if the equity can stay stable or not grow too much, so there is a chance for the third party investor in terms of bank loan, issue bond, and etc. coming in to finance the expansion, and asset will inflate it again and again. So the process is like that, meaning that the management or the owner of the company, in order to attract investor coming in, they may share or distribute part of the profit as a dividend. So dividend coming out, and then the fund from investor coming in. So the faster, the bigger the amount from the investor coming in, so the chance to inflate the asset is bigger. Right. Next is the low return on asset. is assigned to avoid the bad stock because it shows low productivity. It shows non-productive asset. As a company with low return on asset, meaning they have so much asset unutilized, non-productive or less productive. So they will be becoming a target of the takeover. So what is the solution? The solution is we have to improve, we have to make non-productive asset becoming productive. How? Can be sell off, partnership, spin off of the non-productive asset to basically take out the asset from the company and then utilize elsewhere or outside the company, becoming more productive. So what left in this company is only productive asset, and it will be look sexy and attract the investor to investing in. So the next is negative free cash flow. What caused the negative free cash flow is too expensive in terms of capital invested. Capital invested or capex may higher than EBITDA, earning before interest, tax, depreciation, and amortization, or is basically low earning, low profitability. What is the solution? Solution is the company can make somebody else out there to invest it for them, meaning they can build and sell to the other and lease back or rent. Build, operate, and rent can be like that. It's the case of the capital intensive company like technology company, like telecommunication company. They can outsource the asset and lease back. The other option is to franchise or to licensing. So next is negative working capital. It's very risky in the very short term for the liquidity because if we make the valuation, the negative working capital can result the negative value. What is the negative value? There is very risky for the company, especially when the short-term debt is due, because short-term debt is less than 1 year. Solution is issuing bond to buy back the existing debt which is due to mature, or we call it exchange over, bonds exchange over. We can do right issue to pay off the debt. So next is negative liquidation value. Liquidation value in this case is we are talking the total debt compared to current asset, net current asset to be specific. If the company have positive working capital, they not necessary to have the positive liquidation value, meaning they can cover the short-term debt, but they cannot cover both short-term and long-term debt or the total debt. The number can be negative or negative liquidation value. So for the short term, it can be survived, but not in the long term. What the solution? Solution is of course improvement of the top line and the bottom line. Increase sales in order to increase profit. How about just increase sales but profit not improving? Still a help because a return or sales turnover or sales compared to asset ratio maybe be improving, still improving, but it cannot be last long. It's gonna be temporary since the bottom line not improving. So next is the case. What's happened if the company avoid too much capital invested or even no capital invested? Is it the good company because they can spend the profitability, the profit they are making without covering a huge expense for capital? It seems maybe good in the first look, but actually not. Company without investing in the capital is company with no expansion. It's a dying company, no growth company. So that's why if the company don't invest in the capital, you see the earning after tax on this list, you see more than 10 companies, they're running losses or maybe making very tiny profit. So let's see the other financial ratio, gross margin, net profit margin, most of them negative or not applicable, meaning there is no revenue. So you see 3 company, the NCF, Asia and PWSI, they don't make revenue at all. They don't make a sales. They don't make a sale, so there is no financial ratio for the profit margin and gross margin. Debt equity also, most of them are negative. Negative meaning they are making losses or they have negative equity. So in this list, there are only 2 companies which have a positive numbers. I don't say positive performance, but positive number. One is BTech and the second is DEFI. DEFI is a finance company. It's very tiny stock. You see the market capitalization is less than 100 billion. It's cheap stock. There's no prospect, but the number is quite good, quite impressive. Net profit margin above 50, gross profit margin above 40, which is unrealistic. The net profit margin is bigger than gross profit margin because the other income, non-operating income. Debt equity ratio less than 1%. Return on equity, of course, is very, very small. But even though the net income positive, they're making a profit, but the asset is very small. So there is no prospect, nothing. The company like this just have a very few or a little operation, few people operating, maybe not permanent, and then just waiting for the big blow. Waiting, they just a broker of the project, is a mediator. So how about BTech? It is a technology agribusiness company. The market capitalization is less than 2 trillion. Asset is 100 billion. You see, return on equity is very small, 4%. Debt equity is good, less than 1. Net profit margin very small, below 10. Gross profit margin 16. So with there is very low financial ratio, the tech is no prospect. Now take a look at other mining sector. If you see in this chart showing in the last 3 years or 2 years, mining sector is a bad performance. So what is the worst among the member of this industry? The list, there is 8 companies. We rank from the market capitalization. First being Bumi, the largest coal mine in this country. They're running losses, negative free cash flow. The balance is too bad. Working capital negative. Liquidation value even worse, with the total deficit almost 50 trillion in rupiah. Return on equity negative 75% because big loss. Debt equity far away so much, 20 times equity is too much. Negative net profit margin and negative return on asset. Only gross profit margin positive 20%, 21%. It shows the company cannot survive. With such a debt equity cannot survive. Despite they own very lucrative and very promising coal mines. But if the price of the coal not improve so fast, so they will be crashed with payment of the interest, or even when the debt is due. It's very dangerous situation. Well, from this list, I highlight only one company, which is considered the best among the worst. It is a Medco. Medco actually overvalued. The price is 1,800 and true value is 2,800. Is it worth it to buy? Wait a moment. True value not necessarily is good for buying, but it need further analysis. Okay, let's talk one by one. Free cash flow negative, working capital positive, that's good. Positive 6.4 trillion. On the other hand, liquidation value deficit 6.8 trillion. What does it mean? Positive working capital almost equal to deficit in the balance sheet, liquidation value. So the problem is when, or too risky when the debt will due. How can they pay that such amount? Can they pay with the internal cash? They may pay with the internal cash, which is working capital is positive, but they stop the operation. So what the solution? They issue the bond, exchange over to pay off the debt, or maybe right issue if there is a prospect. It's very difficult because oil and gas business is no growing business, especially in the upstream business, because Medco mostly doing upstream business. It's very risky, exploration and exploitation. So what happened? The debt equity ratio is above 2. So when debt do, true value may drop and becoming negative value. Solution only one. Bottom line, the profitability must improve immediately. Looking at such industry, maybe it's difficult for them to improve. There is a small chance. Why small chance? Because free cash flow is negative. Meaning, they can make money, but they have to invest it in the capital. At the end of the day, the invested capital is higher than the money they are making. So they have a negative cash flow. So the solution, either capital reduce or earning improve. And if we see the net profit margin is only 3%. Well, there is sounds only gross margin. 44% looks okay. What is the solution? Medco must reduce operation costs, cut overhead, cut staff, lay off. So there is only the solution. The rest of the list, either very low market capitalization and bad financial ratio. The next one may be only BP. The market capitalization is or Medco, but true value negative because free cash flow negative, working capital negative, liquidation value negative. Return on equity less than 1% doesn't fly. That equity may be okay below 1, but negative profit margin, return on asset is very small. There is no prospect. So next we'll see what is the most growing sector in the last 2 years. It is property and finance sector. It is the most growing. So we see what is the performance of the bad companies. Of course, they are running. They consider the least impacted. Finance sector has only 2 members having the bad performance, ENCF, MTFN, with very tiny market capitalization. Nobody invested, nobody interested, true value negative, free cash flow negative, working capital liquidation negative. What can they expect? Cheap stock. Next, property and real estate. There are 4. They are all running negative free cash flow, working capital, liquidation. All negative. But we highlight the last 2 company in the bottom, which is the biggest market cap among the 4, LT and Wika. LT running real estate developer, Wika running as a building construction. If we compare both companies, what's happening? LT has debt equity less than 1, Wika more than 3. Is it good? Wait a minute. Debt equity low, the result of too much equity but low return on equity, very low or even negative, because they're making losses. Wika still making profit. But if we are looking, even though Wika making profit, how about the financial ratio? gross margin only 9%, profit margin only 2%, return on asset only 2%. They just depend on return on equity because they don't utilize equity since they just went public 2-3 years ago, owned by the government, state-owned company. So I guess there is low profitability of Wika. How about LT? The most hope of LT only gross margin 46%. The number of 46% meaning LT as a company has a lot more chance or make better performance by selling their goods, so make the top line growing. Top line is still growing because gross margin 46%. The problem is, even though the top line growing, the bottom line negative, they're making losses. The prospect is still there. LT has a little more prospect than Wika. Because Wika has no performance, very tiny performance. But even though the prospect is there, LT making losses, meaning their such operation is very burdening. The operation showing that non-productive asset, you can see from return on asset. So there is so much non-productive asset, they have to spin off, sell off to make the performance it's look more sexy. It's too fat, they have to sell off. Sell off the asset also reduce the operation cost. Alright, there are so many more in-depth analysis on the other sector, so see you next time.